Something significant just happened in the federal funds rate market. The probability of the Federal Reserve cutting rates at its next meeting has dropped 14 percentage points in a single session, from 56% down to 42%. With nearly $2 million changing hands in 24 hours, this is not statistical noise. Something has materially shifted in the market's collective assessment of where monetary policy is heading, and three distinct news events explain precisely why. Three distinct pieces of news converged to drive this repricing, and together they form a coherent picture. First, the latest inflation print came in hotter than expected, 3.4% against a consensus forecast of 3.1%. That single data point reopens the question of whether inflation is truly on a sustainable path back to target. Second, Jerome Powell's remarks at a closely watched event struck a notably hawkish tone, with no language suggesting the committee feels any urgency to ease financial conditions. And third, perhaps most telling of all, two voting members of the Federal Open Market Committee publicly pushed back against the prospect of near-term cuts. When the individuals who actually set the rate speak plainly before the blackout period, the market has learned to take them at their word. Let us be precise about what this move represents mechanically. When a prediction market contract drops 14 percentage points in a single session, that reflects a genuine redistribution of capital. Participants who held long positions on a cut are selling their contracts, and new capital is entering on the no-cut side at lower prices. At 42%, the market is close to a coin toss but leaning meaningfully away from a cut. The $3.15 million in liquidity depth is a critical detail. A shallow, thinly traded contract can be moved cheaply and tells you little. This contract has genuine two-sided interest from informed participants. The price discovery here carries weight. The market is assigning roughly 3-2 against a cut at this specific meeting. Beyond the headline probability number, the smart money flow signal on this contract is pointing firmly in one direction: sell. This means the participants with the strongest historical accuracy on prediction markets, those whose prior positions have proven correct over time, are actively reducing their exposure to the rate cut scenario. This distinction matters because smart money flow frequently leads the broader market's repositioning by anywhere from 12 to 48 hours. When capital from informed participants moves ahead of the headline repricing, the move tends to have further to run before equilibrium is restored. The signal here is not ambiguous, and it is consistent with what the news flow is saying. This pattern has clear historical precedent. At Jackson Hole in 2023, a comparable repricing occurred when Powell signaled that the committee was prepared to tolerate tighter financial conditions for longer than the market had anticipated. Contracts that had priced in cuts by year-end unwound sharply over the following 48 hours. More broadly, when inflation prints surprised to the upside by more than 0.2 of a percentage point relative to consensus forecasts, the historical pattern is for the Federal Reserve to extend the hold cycle by at least one additional meeting, sometimes two. And public dissent from FOMC voting members, particularly in the weeks before the blackout period, is rarely rhetorical positioning. When voters speak against near-term easing on the record, the subsequent meeting minutes tend to reflect that internal tension explicitly. The market is reading these signals in the correct historical frame. Several catalysts now stand between the present moment and the FOMC decision itself. The next Consumer Price Index release is the single most important data point. A second consecutive upside surprise would, based on historical patterns, likely push this contract below 40% and potentially much further. Jerome Powell has scheduled remarks that the market will pause with considerable attention for any shift in tone or language. Non-farm payrolls will also matter. A labor market that remains resilient removes the Fed's primary justification for easing financial conditions. Each of these events has the potential to move this contract significantly in either direction. If you want to follow the probability in real time as each catalyst lands, subscribe to this channel and find the full interactive market view at polymarkettrade.app, where every significant move is tracked as it happens.